Section 5.3 Understanding Standard Deviation. 5.3 Performance Evaluation and Comparison. Evaluating investment performance using risk-adjusted metrics based on standard deviation, such as the Sharpe Ratio and the Sortino Ratio, provides insights into how well an investment has performed relative to its level of risk. These metrics help investors assess the risk-adjusted returns and compare investment options. Here's an explanation of the Sharpe Ratio and the Sortino Ratio. Sharpe Ratio. The Sharpe Ratio is a widely used risk-adjusted metric that measures the excess return per unit of risk, as measured by standard deviation, of an investment. It is calculated by subtracting the risk-free rate of return from the investment's average return and dividing the result by the investment standard deviation. The formula for the Sharpe Ratio is Sharpe Ratio equals average return, risk-free rate, / standard deviation. A higher Sharpe Ratio indicates a better risk-adjusted performance, as it implies a higher return for each unit of risk taken. It helps investors evaluate the efficiency of an investment in generating excess returns relative to the level of risk undertaken. The Sharpe Ratio allows for comparisons between different investments or portfolios, with a higher ratio indicating better risk-adjusted performance. Sortino Ratio. The Sortino Ratio is another risk-adjusted metric that focuses on downside risk rather than overall volatility. It measures the excess return per unit of downside risk, as measured by downside standard deviation, of an investment. Downside risk is defined as the standard deviation of negative returns or returns below a certain threshold, often the risk-free rate of return. The formula for the Sortino Ratio is Sortino Ratio equals average return, risk-free rate, / downside standard deviation. The Sortino Ratio provides a more targeted assessment of an investment's risk-adjusted returns, as it considers only downside deviations. It is particularly useful for investments where protecting against downside risk is a priority. A higher Sortino Ratio indicates better risk-adjusted performance, with a higher return for each unit of downside risk taken. By using these risk-adjusted metrics, investors can evaluate investment performance beyond absolute returns. They provide a way to compare investments or portfolios while considering the level of risk involved. However, it's important to note that both the Sharpe Ratio and the Sortino Ratio have limitations and assumptions. They assume a normal distribution of returns and may not capture all types of risks. It's advisable to use these metrics in conjunction with other measures and consider the specific characteristics of the investment and the investor's risk preferences when assessing investment performance. When comparing the risk-adjusted returns of different investment portfolios or strategies, several metrics can be used to evaluate their performance. Here are some commonly used measures. Sharpe Ratio. The Sharpe Ratio compares the excess return of an investment portfolio or strategy to its volatility, as measured by the standard deviation. A higher Sharpe Ratio indicates better risk-adjusted performance, as it reflects a higher return per unit of risk taken. Sortino Ratio. The Sortino Ratio focuses on downside risk rather than overall volatility. It compares the excess return of an investment portfolio or strategy to its downside volatility, as measured by the downside standard deviation. The Sortino Ratio is particularly useful for strategies that aim to minimize downside risk. Information Ratio. The Information Ratio measures the risk-adjusted return of an investment portfolio or strategy relative to a benchmark. It calculates the excess return of the portfolio or strategy compared to the benchmark, divided by the tracking error, which is the standard deviation of the excess returns. A higher Information Ratio indicates better risk-adjusted performance relative to the benchmark. Trainer Ratio. The Trainer Ratio compares the excess return of an investment portfolio or strategy to its systematic risk, as measured by the portfolio's beta. The beta represents the sensitivity of the portfolio's returns to changes in the overall market. The Trainer Ratio helps assess the risk-adjusted performance of the portfolio's systematic risk exposure. Kalmar Ratio. The Kalmar Ratio evaluates the risk-adjusted performance of an investment portfolio or strategy by comparing the annualized return over a specified period to the maximum drawdown. The maximum drawdown measures the largest peak-to-trough decline in the portfolio's value. A higher Kalmar Ratio indicates better risk-adjusted performance, as it reflects a higher return relative to the magnitude of the portfolio's drawdowns. Omega Ratio. the omega ratio considers the entire distribution of returns and focuses on downside risk. It calculates the probability-weighted ratio of positive returns to negative returns. A higher omega ratio indicates better risk-adjusted performance, as it suggests a higher likelihood of positive returns relative to negative returns, when comparing the risk-adjusted returns of different investment portfolios or strategies. It's essential to consider the specific objectives, time horizons, and risk preferences of the investor. Additionally, it's important to assess the limitations and assumptions of each metric and consider other factors beyond risk-adjusted returns, such as the investment's consistency, correlation with the investor's goals, and alignment with the investor's risk tolerance.